Jason, it's good as always to see you. Why did you sell Facebook, and do you have a more or less favorable view of it today as we await its earnings?
Good afternoon, Tyler. So we sold Facebook a couple of years ago, really based on the cultural crisis that we saw at Facebook developing. They had a number of internal issues across, whether it was racism, bigotry, hate speech, you name it. But outside of that, things like Cambridge Analytica, and quite frankly, I believe it was your own organization that around the same time published a pretty exhaustive piece on some of the problems at the culture at Facebook regarding, basically discouraging dissent among employees. Things like that really were a signal to us that perhaps the best days for Facebook were behind it, and we could get the same type of exposure to the market in which we were investing via Facebook, that is digital advertising growth, through our investment in Alphabet or Google, who we saw had a great report yesterday. So we ended up adding to Google and removing Facebook. We've been largely happy with that trade. As we look at it today, I think they've recognized some of the issues, to be sure, but it's going to take a long time and more than lip service and a lot of money to truly fix the issues at Facebook. So we see, we can get the same type of secular growth in digital advertising along with cloud and other things that Alphabet's doing without having to take on the problems of culture, which Facebook is still trying to work through.
I think Facebook, this isn't about me or my impressions of it. I am not on Facebook, but I think it is a very effective tool. What I would worry about for selling things and communicating and so on and so forth, what I would worry about if I was Facebook is that younger people don't use it. They may be using Instagram, they may be using WhatsApp, which are two properties of theirs, but increasingly they're on other platforms and not using Facebook. Let's move on to Amazon, which you do like, despite the fact that the stock has basically been consolidating or hovering like a foreign spaceship for a long time.
Yeah, we continue to like Amazon. As you noted, it's been consolidating for about 18 months. Meanwhile, the per share fundamentals of the company, the underlying company, Amazon, continue to do quite well. Revenue's up around 25% over the same period that the stock has been in a sidelong pattern. So what that means is that the valuation on the stock and the way that we valued Amazon for as long as we've owned it is on a price to revenue basis because they put so much of their profit back into growing the business. I think that's the best way to look at it. It's trading around 2.6 times our estimates for revenue this year, which are about $570 billion, so it's a big, big number. Meanwhile, the company continues to fire on all cylinders across e-commerce, across cloud, AWS. We expect a big number in the quarter. Prime, we're probably going to see a price increase for Prime, which will flow right to the bottom line and might add $8 or $9 to earnings this year alone. So we really like the setup for Amazon after a big investment year. Stock is cheaper now than it's been since we've owned it. I would actually go out on a limb and call it cheap based on its intrinsic value that we see over the next 5 or 6 years.
So, Jason, I'm curious what you make as an investor of this trend kind of away from guidance where Apple doesn't guide anymore, Google doesn't guide, right. Microsoft guides 1 quarter, Amazon typically 1 quarter at a time. Is this a help or a hindrance?
Yeah, it's a really great question. We see it as a help, believe it or not, because our view is that investors need to focus on the long term, and oftentimes guidance over the short periods of time, whether it's quarterly guidance, even annual guidance, but less so, can be a bit of a distraction for the long-term minded investor. I think we do a pretty good job of finding the signal in the noise and not paying too much attention to what the next 3 months look like, and instead focus on what the next 3 years looks like. But not everyone is as well versed in controlling themselves and acting accordingly. So I actually think the lack of guidance can be a help to long-term investors. That said, I don't think public companies should restrain themselves from giving some kind of, outlook or understanding to the investment community about how their business is doing and what they anticipate that might be challenges over the short term. So it's a bit of kind of a mixed answer. I recognize that, but I think overall, paring back guidance can be a good thing.